Hello, welcome to Accounting 2010 Chapter 6 videos. In video 3, we are going to be continuing to work on the Gulf Haven problem. And so in the previous videos, we talked about inventory and cost of goods sold, flow assumptions, and how we assign costs. We also discussed how we calculate the sales revenue based on numbers that are given to us in our problems. Now in video 3, we are going to actually start applying the concepts of FIFO, LIFO, and weighted average to determining the cost of the products that we sold, the cost of the goods sold, and the value of the inventory on hand based on using the assumptions. In video 3, I'm going to talk about FIFO, and then in video 4, we'll talk about LIFO and weighted average so that the length of these videos are a little shorter. So let's again go back to the Gulf Haven problem. And in Gulf Haven, we are a company that sells putters and other golf clubs. And we are Gulf Haven. And we sell our golf clubs and our golf putters for $128 a piece to our clients. However, based on which cost assumption we apply to the cost of goods sold and inventory on hand, it will change what our cost of goods sold is. And that will be the number we will use to ultimately calculate gross profit. So let's go ahead and take a look at the problem. So Gulf Haven, we have on November 1st, we are a company that's been going on, and so we have a balance in our inventory from the previous period of 17 putters at a cost of $68. That is what vendors charged us for the putters. So we have 17 putters sitting in our inventory on hand that cost us $68 a piece for a total cost of $1,156. And then we also can look at these other categories. We have columns to record any purchases we've made. We have a column of which we will list the cost of the goods we sold, the products we sold, and the cost to us, not what we sold them for, but the cost to us. And we'll keep track of how much inventory we have left in the store. So on November 1st, from the previous period, we have 17 putters that cost us $68 a piece and a total value sitting in inventory of $1,156. Then it says on the 6th, we sold 7 putters. So the first thing we have to do is think about which 7 putters did we sell. Well, since we only had one layer of inventory, 17 putters that cost us $68 a piece, we're going to say that the cost of those products, the cost of the putters, cost of goods sold, we sold 7 that cost us $68 for a total cost to us of $476. Well, if we sold 7 putters and we had 17 to begin with, it means that in our inventory we have 10 putters that cost us $68 a piece, and so the value sitting in our inventory at that time is $680. All right, we're ready to go on to the 8th. Nothing must have happened on the 7th, so on the 8th we made a purchase. We bought some putters. Christmas is coming. This is November. We're gonna buy some putters to keep a few more putters in the store. So we're gonna purchase 20 putters, and we're paying, the vendor is charging us $74 for each putter. That gives us a total cost, 20 times $74. That purchase cost us $1,480. And so now in our store we have 2 layers of inventory. We have the original 10 putters that we had remaining from a previous period that have not yet sold for $680. Now we also have 20 more putters, and we're going to keep track of each layer, and you'll see why when we start to sell. 20 putters at $74, that's what we paid, and 20 times the 74 we had determined was $1,480. 20 times 74 is equal to 1,480. So we have total inventory now, 10 putters at $68, 20 putters at $74, our total inventory. Now the problem tells us we're going to make a sale. And in order to record the sale, we're going to go into the cost of goods sold. And it says we sold 20 putters. But the question is, which putters did we sell? Well, under the FIFO assumption, under FIFO, the first putters that were in the store, our oldest putters, are going to be the first putters that go out. 20 putters. Well, our oldest putters are these 10. 10 at 68. All right, we're going to go ahead and say that we sold all 10 of those. We're just going to make that assumption. These are assumptions. $680. But we sold 20 of them and there were only 10 here. And this layer is completely wiped out. Under this assumption, we're going to wipe that out. It's going to say we're out of the store. So where do we get the other 10 putters? Well, out of this layer. So we're going to say 10 putters out of this layer at $74. And that would be $740. So how many putters do we have left and which putters? Well, under the FIFO assumption, first one's in with the first one's out. We sold 20. These are gone. 10 of these are gone. It leaves in inventory 10 putters. These 10 putters at $74. And in inventory, $740. Now on the 30th, we made one more sale, 4 more putters. 4 putters. Which 4 putters? Well, these are the only putters left in. We've got to take it out of this layer of inventory. 4 putters at $74 is equal to 4 times 74. A total cost of the sale of those 4 putters. Our cost, not what we sold them for. We sold them for $128, but it cost us $74, $296. How many putters are in the store and which putters? Well, we had 10 putters at 74. We sold 4 of them. We've got 6 putters left at a cost of $74 is equal to 6 times 74 for a total cost of $444 remaining in inventory. The cost of those putters to us, that's what we paid for them, $444 worth of putters sitting on our shelves, and we've got a total cost of the goods we sold. We had basically 3 sales on the 6th, the 17th, and the 30th. A total of 31 putters went out the door at a total cost. If we add up the total cost from all the sales, we have a total cost of the goods sold. The total cost of the putters sold to us was $2,192. 31 putters sold to a cost to us of $2,192. There are 6 putters in inventory for a total cost to us of $444. We can say under the FIFO method, the cost of the putters we sold were $2,192 and the remaining inventory is $444. And in the next video, we will go on and we will calculate LIFO and see what the difference in the cost of the goods sold by taking on a new cost assumption, assigning the newest cost, the last ones in, the last putters in, will be the first ones sold. So we'll be, instead of assigning the oldest cost, the first ones in are the first ones sold, we'll be assigning the newest cost. The last ones in will be the first ones sold. And we'll see what a difference that makes in calculating our gross profit.